All right, let's dive right into this. Welcome to Iron Financial. I'm your lead analyst, and my mission today is to help you forge a stronger portfolio and cut straight through the market weakness we're currently witnessing out there. Look, in this explainer, we aren't dealing in hype, and we certainly aren't dealing in hope. We are looking for absolute, undeniable structural integrity in the markets. And today we are taking a sledgehammer to Coinbase's Q1 2026 earnings report to see exactly what is holding this company up. We're going to stress test the foundation of the largest crypto exchange in the United States to find out if it's actually built to last or if it's just a house of cards. And I'm the market skeptic, because let's be entirely real here for a second. In this current market environment, you absolutely cannot afford to just take a management team's word for it. They are always going to try and sell you the most optimistic blueprint. I'm here to represent you, the audience. I'm going to be asking the tough questions, looking for the hidden cracks. Is this just more crypto hype, or is there real, tangible, load-bearing value here? We're going to push for absolute clarity on these numbers, and let me tell you, we are not going to let any financial spin go unchallenged today. So the central question for this explainer is pretty simple. When you look at the recent massive volatility across the digital asset space, we have to stop and ask, is Coinbase forged in iron, built to withstand this kind of brutal cyclical beating? Or is the core business model actually cracking under the immense pressure of a shifting economic reality? There's been an enormous amount of retail and institutional hype surrounding their new product lines over the past year. But listen, hype doesn't pay down debt obligations, and hype certainly doesn't build a durable margin when trading volumes completely dry up. We need to know if the underlying architecture is actually sound when the storm hits.
To understand the micro financials of the company, you really have to look closely at the macro stage first. The sheer force of the headwind Coinbase faced in Q1 was absolutely brutal. While Bitcoin dominance stayed relatively stable, even BTC pulled back significantly from its 2025 highs. Remember, it peaked above $125,000 right before the broader market rollover. But the real structural damage, that was seen across the rest of the market. Many mid-cap and small-cap assets completely failed to maintain their gains, showing massive stress fractures. The altcoin season index absolutely plummeted, and that was even with the successful launch of several spot altcoin ETFs in the US. The market simply lost its momentum, capital fled to safer harbors, and liquidity just dried up across the board.
And let's put a hard, undeniable number on that market weakness, just so we are all on the same page. We are talking about a massive, sweeping 20% drop. Total crypto market capitalization and overall trading volumes both declined by more than 20% quarter over quarter. And spot volumes? Down an incredibly painful 37%. This is the ultimate stress test for any digital asset exchange. When the tide goes out this fast, and the overall market volume drops by over a fifth in a single 90-day period, you immediately see who built their house on a solid foundation of concrete and who built it on shifting sand.
Now, consider what we call the macro paradox. While the crypto markets were bleeding out and shedding billions in value, the broader traditional economy was actually standing on incredibly solid footing. Inflation held remarkably steady at 2.7% in the December CPI reading, totally brushing off widespread tariff fears that had analysts panicked earlier in the year. And look at domestic production. The Atlanta Fed's GDP Now model projected a highly robust 5.3% real GDP growth rate for the fourth quarter. So we really have to ask the critical analytical question here. Is Coinbase's Q1 weakness simply a casualty of a temporary crypto-specific pullback, or does it reveal fundamental structural flaw in their business model when it becomes totally disconnected from broader macroeconomic strength?
Let's systematically drill down into the financials. We are going to forensically examine these top-line numbers to see exactly where the specific fractures are located. Total revenue took a 21% structural hit, dropping down to $1.41 billion. When you look deeper into the engine, transaction revenue bled out 23%, and even subscriptions and services fell 16%. But listen, in this business, context is everything. While total revenue dropped 21%, remember that overall crypto market volumes dropped a massive 28%. So, structurally speaking, the foundation is actually holding up slightly better than the broader market forces that are battering against it.
Hold on, let's heavily interrogate this shifting foundation. You've got transaction revenue sitting at $756 million and subscriptions and services at $584 million. Management absolutely loves to tout this subscriptions and services line as their durable buffer against market volatility. It now makes up a massive 44% of their net revenue. But is it actually doing enough heavy lifting? When your core transaction engine stalls out and drops by nearly $250 million in just 3 months, can you really rely on passive subscriptions and interest income to keep the entire skyscraper from swaying in the wind? Is this true, robust diversification, or is it just corporate life support?
To answer that, the specific stress points are where the story lies. I don't want broad summaries, I want the raw data. Consumer transaction revenue took a massive hit, coming in at $567 million, which is a 23% quarter-over-quarter decline. But notice that consumer spot trading volume actually declined 35%, so they successfully offset some of that structural damage through a mix shift, meaning users moved toward higher fee or different types of trading products that preserve better margins for the company. Institutional transaction revenue bled out even faster, dropping 27% to $136 million, which falls perfectly in line with the broader market declines. Other transaction revenue dropped 17% to $53 million due to lower instant transfer and base network revenue. There's just no denying it, the core engine definitely stalled out.
So let's inspect the structural integrity of that subscriptions and services revenue you were just questioning, because this is the load-bearing pillar management is desperately relying on. Out of that $584 million, a staggering $305 million is generated directly from stablecoin revenue alone. That is driven by a massive all-time high of $19 billion in average USD held directly in Coinbase products. That's a huge deal. Blockchain rewards brought in $101 million, which actually saw underlying growth in native units staked, but was dragged down on the ledger by lower overall asset prices. And interest and finance fees provided another $68 million. Look, this isn't just a minor buffer. This is a completely different yield-bearing foundation they've constructed entirely beneath the legacy exchange.
And that yield-bearing foundation is exactly why they survived the pullback without totally collapsing. Despite the brutal market contraction, Coinbase still delivered an adjusted EBITDA of $303.3 million. Yes, obviously it's down substantially from Q4's $565.9 million, but the absolutely crucial point here is that this marks their 13th consecutive quarter of positive adjusted EBITDA. They maintain this profitability metric through rigorous, almost ruthless cost discipline. Their adjusted expenses were heavily managed down to $1.13 billion, an 8% drop quarter over quarter, reflecting aggressively lower general, administrative, sales, and marketing costs. They are flexing their operational costs perfectly with the shifting market tide. That, my friends, is the very definition of operational durability.
Okay, I'm going to have to aggressively counter that praise right now. You want to talk about a solid foundation? I'm looking at a massive, glaring crack in the armor. Negative $394.1 million. That is their GAAP net loss for the quarter. You can talk about adjusted metrics all day long to make the spreadsheet look pretty, but at the end of the day, when you strip away the accounting adjustments, this company bled nearly $400 million. Now, management claims this was largely influenced by mark-to-market losses on crypto assets held for investment. That means they had to record a severe loss simply because the crypto assets they hold on their balance sheet went down in value during the quarter, even if they didn't actually sell them. But guess what? A loss is a loss. It severely weakens the balance sheet, it erodes shareholder equity, and it proves they are still incredibly vulnerable to price swings.
And it's not just the absolute loss, it's how badly they missed Wall Street's expectations. The institutional prop desks and research analysts severely misjudged this stock's durability. The consensus heavily estimated $1.41 billion in net revenue. They only delivered $1.33 billion. The street expected $791 million in transaction revenue. It came in weak at $756 million. Analysts modeled for a robust $408 million in adjusted EBITDA. Coinbase missed that target by over $100 million. And the GAAP net income, the street expected a totally manageable $29 million loss, and Coinbase dumped a highly toxic $394 million loss on the table. The market completely mispriced the risk profile here, and it shows deep structural forecasting issues. Look, the institutional misses are severe. There is absolutely no denying that. But we have to look closely at what they are aggressively building beneath the surface to see if the analysts are completely missing the long-term structural pivot.
Because while the core spot trading numbers clearly missed expectations, you absolutely have to acknowledge the very real green shoots. They are actively forging new growth through what they are calling the everything exchange. New steel beams are going up, people. Derivatives volume on a trailing 12-month basis grew an astronomical 169% year over year. Retail derivatives alone just hit an all-time high, successfully crossing $200 million in annualized revenue. Their brand new prediction markets, they reached over $100 million in annualized revenue in less than 2 months of operation. And their decentralized exchange, or DEX, trading volume doubled quarter over quarter. The legacy business might be under immense pressure, but these new verticals are scaling explosively and adding critical new pillars.
Let's move to the most critical metric of market dominance, 8.6%. That is Coinbase's new all-time high in crypto trading volume market share globally. Think about that for a second. While the overall pie shrank by a massive 20%, Coinbase actually took a larger, thicker slice of what remained. They are consolidating raw power during a brutal bear market. They also now securely store 12% of all global crypto assets. When weaker, less regulated trading platforms crack under the pressure of a drawdown, the trading volume naturally flows to the platform with the thickest iron doors and the deepest compliance moat. They're actively weaponizing their regulatory trust to choke out the weaker competition.
Okay, they are clearly gaining market share in a shrinking environment, I'll give you that. But let's go back to the subscriptions and services side. They talk a massive, highly optimistic game about their proprietary Layer 2 network, the base chain. Is this just more Silicon Valley tech hype, or is it actually moving the financial needle and bearing real weight?
It is absolutely doing the heavy lifting, and the durability is proven, right here in the usage metrics. The total USDC market cap reached a massive all-time high of $80 billion in Q1. Out of that staggering number, an average of $19 billion is held securely and directly within Coinbase products. Because of their deep structural integration, Coinbase is successfully capturing roughly 50% of all USDC economics globally. And as for the base chain you questioned, stablecoin transactions on Base are up 10x year over year. That is exponential, tangible utility happening right in the middle of a market drawdown.
And if you want to look at the future structural framework of the entire digital economy, you have to consider the base chain. Over 90% of on-chain agentic stablecoin transaction volume happens entirely on Base. Now, what does that mean? It means automated AI agents transacting directly with each other without any human input. We're talking about the intersection of artificial intelligence and crypto operating at the absolute speed of the internet. The structural rails for this entire next-generation agent economy are already fully built, and they are operating almost exclusively on Coinbase infrastructure. If software agents eventually outnumber humans in the next decade, Coinbase is flawlessly positioning itself to be the undisputed, high-margin toll road for that entire economic system.
We also have to heavily factor in the institutional concrete being poured. According to highly detailed primary research conducted by EY Parthenon, institutional money is not retreating in fear, it is actively reloading its weapons. 77% of smaller firms, we're talking those with $1 billion to $5 billion in assets under management, plan to significantly increase their crypto holdings in 2026. And 69% of the massive mega firms managing $51 billion to $500 billion plan to do exactly the same. Despite the severe Q1 retail weakness and the retail panic, the true smart money is using this exact volatility to drive operational discipline and prepare to pour massive structural capital onto institutional-grade platforms like Coinbase Prime.
All right, I will fully concede this one absolutely crucial point. When you are deeply stress testing any company, the ultimate backstop, the final line of defense, is the balance sheet. And Coinbase exited Q1 with an enormous $10.2 billion in cash and cash equivalents. That is an incredibly thick layer of armor against any further market drops. That cash pile gives them the massive capacity to fund a $2.1 billion share repurchase program, absorb those brutal mark-to-market crypto asset losses without even blinking, and continue to aggressively deploy capital into growth areas like derivatives and the Base network, even while the legacy spot market remains completely stagnant and frozen.
So let's tightly summarize the fundamental goal case here. CFO Alicia Haas said it perfectly in the earnings call. The market environment this quarter was softer, but the underlying fundamentals of our business remain strong. They undeniably delivered their 13th consecutive quarter of positive adjusted EBITDA, 12 consecutive quarters of native unit inflows onto the platform, and they have successfully engineered 12 completely different product lines that are each generating well over $100 million in annualized revenue. They have successfully decoupled the survival of the business from the day-to-day price of Bitcoin. That is true, undeniable structural durability.
Yeah, but on the flip side of that exact same coin, CEO Brian Armstrong stated, "We executed well on what was in our control. We hit a new all-time high in USDC held in Coinbase products." And while that statement is factually accurate, you have to weigh that management spin against the cold, hard reality of the situation. They brutally missed Wall Street consensus estimates across the entire board, missing on net revenue, missing on transaction revenue, and missing on EBITDA. They posted a highly painful $394 million GAAP net loss. Management can tightly control their operating expenses, and they are clearly doing a very good job of that, but they still cannot control the broader macroeconomic tide, and when that market tide rapidly goes out, this company still bleeds heavily.
Which finally brings us to our ultimate iron financial verdict. The raw numbers are laid completely bare for you to see today. They heavily miss the analyst estimates, and the legacy spot market remains incredibly weak. But at the exact same time, they are capturing absolute record market share.
scaling their derivatives platform explosively, totally dominating the global stablecoin economics, and they are sitting securely on a fortress balance sheet of $10.2 billion in pure cash. So, the question you have to answer for your own portfolio strategy is this. Are you buying the underlying structural integrity of the Everything Exchange and their rapidly growing high-margin subscription revenue? Or are you looking at a severe $394 million quarterly loss and a massive miss on consensus estimates as fatal, unfixable cracks in the armor? Is this a truly solid foundation to build a long-term position upon, or is it just an elaborate value trap hiding behind a rising market share? Look closely at the data, weigh the results of the stress test, and make your call. Stay disciplined out there, and we will see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.